Welcome back to my channel, Miss Personal Finance. In today's video, it'll be a continuation of the homeownership series where we go over home buying tips and the foundation to obtaining a home loan or mortgage. So we've discussed the credit profile, the importance of steady income, and now we're on to money in the bank, which essentially are assets. Now, to qualify for a home loan, we know you have to have decent credit, income that is likely to continue, and then you also need assets. Assets are going to be money or cash equivalents, things that can be sold or leveraged for cash, such as savings, checking accounts, 401ks, stocks, bonds. All of these things can be considered assets. Now, money in the bank is what we would consider liquid. Liquid meaning you can obtain those funds pretty much instantly by either going into the bank, making a transfer, etc. Non-liquid funds are those that take a process in order to obtain. For example, if you have funds in the stock market or 401k, you'd have to actually sell off those shares of stock, convert that into cash, and then get that deposited into a checking or savings account where you now have the liquid cash or the liquid asset. So just think of assets broken up into two different types: liquid, that's readily available, and non-liquid, meaning it's available, but there may be a process. Another example is if you have a home that you're selling. In order to get those liquid funds, you actually have to go through the process of selling the home, making sure that the transaction goes through before you can obtain the cash. Again, whether that's in the form of a check in a checking or savings account or a wire transfer. So assets are also important because you need them to cover certain things that are part of the home loan process, or that can be a part of the home loan process. Depending on the type of loan that you have, such as a conventional or FHA or VA, you'll need a down payment, or you may need a down payment. There are down payment assistance programs, so that's why I said may. You need assets or cash for down payments. You may need assets for closing costs. If this is not being covered by your seller, which most often it's not, then you would be responsible for the down payment, the closing costs, interest rate. We talk about this one a lot, but again, this is the cost of borrowing money, and the lower the rate, the better. So there are lenders that have options to purchase or buy down your interest rate, essentially paying upfront interest to the lender to get that lower interest rate, which is still beneficial over the course of the loan. So you may need assets to cover the interest rate buy down. And then you also may need assets or cash for reserves. Now, reserves are what are part of the calculation that a lender may use to see, in the event of default. We talk about that a lot. That's essentially what the lender is worried or has doubts about when they are lending out a large sum of money, the default or the risk of it, of non-payment. So default reserves essentially guard against default. Reserves are money in the bank that's sitting there that has no other use other than to serve kind of as an emergency fund. In the case of job loss, if you have rentals, in the case of vacancies, if you have lower income or decreased income due to a job change, all of this is covered in reserves. So you may see that a lender may ask, based off of your current loan profile, to show assets, whether they're liquid or non-liquid, to cover such things. Now, the liquid portion would need to be for the down payment, closing costs, and interest rate buy down. Reserves can be non-liquid because it shows you have the funds, there may not be readily available, but in the case of an emergency, in the case that you did lose your job and you did need to pull, let's say 2 to 3 months of income or 2 to 3 months of mortgage payment, you have that 401k, you have that investment account, you have those stocks or bonds that you can essentially sell and use as income to cover the home loan or cover the mortgage amount. Assets can be one of the toughest things to gather as far as the home loan process because it can take time to save up enough money for a down payment. A good rule of thumb is having 20% of the loan amount as your down payment. You may hear this a lot, and it's because it directly affects your PMI or your private mortgage insurance. If you don't have at least 20% of a down payment, you can still purchase a home. All it means is that the lender will charge you PMI, which is private mortgage insurance, against the risk of default. So they're saying because you don't have 20% down, we are going to charge you this insurance in the case of default. So that means it's an additional amount that's tacked onto your monthly mortgage payment to guard the lender against the risk of default. So if you were to default, that private mortgage insurance would come in and help compensate the lender for a portion or all of their losses. Now, if you don't have the 20% and you do pay less than 20% for a down payment, your PMI will most likely be on there until you reach 20% of equity in the home. Or if it's a different type of loan, like an FHA loan, that PMI may be on it for the life of the loan. So that's something you want to consider when going to purchase a home. And that's why that 20% or the conversation around having a 20% down payment is so prevalent. So it's a rule of thumb, but it's not hard and fast, meaning you can still obtain a home loan if you don't have 20% down payment. Now, you can obtain a home loan with as little as 3% down payment with some of the loan programs that are out there. You just have to work with your mortgage broker or your lender to see what options are available to you based off of your profile, your location, and whatever the bank or lender is able to provide, whatever programs that they participate in. So down payments, very important. They're directly tied to the private mortgage insurance, whether you have to pay that additional amount each month. So you want to take that in consideration. But we also know, realistically, unless you have a major windfall, it can take several years to save 20% as a down payment for the purchase of your home. So that's why you do see a lot of loans that have PMI. So the main point of assets is it's important to have cash to cover your down payment, your closing costs, and potential interest rate buy down, and other assets in case you need additional funds to show reserves. And again, this all ties into the foundation, the 3 basic things that you need in order to get started for a home loan, or starting with the mortgage process. That's your credit profile, steady income, and money in the bank. Now, the lender has to be able to verify the source of cash or the source of funds being used for the down payment and closing costs. So this is via a checking account or saving account, monthly statement, 401k, quarterly statements, things like that. They want to ensure that the funds are yours. It's not an additional loan. There are situations where funds can be gifted to you. That will require a gift letter from the donor, usually signed with their information and a brief statement. But you want to make sure that you have those funds in an account that you have access to, that you can provide statements for, and know that it may be several months of statements that they request. That means you can't just put the money in on a Monday and then go to apply for your loan. They're still going to take a look at your previous month's statements and inquire where the funds came from. So you want to make sure you always have a paper trail and you can show and prove or verify the assets that are in your account that will serve as a down payment, closing costs, and costs associated with the mortgage process or the home buying process itself. And keep in mind, the home buying process can be very expensive. Aside from these things like the down payment and closing costs, there may be other inspections like the homeowner inspection, appraisal costs, other inspections depending on the home, the age of the home, and repairs. So you want to make sure you have as much cash or cash equivalents as possible before beginning the process, because depending on the home, depending on the situation, you never know how much extra cash you're going to need for the process. Overall, you want to make sure that you have money in the bank to serve these purposes, or that you participate in a mortgage program that will help towards the down payments. Sometimes sellers even provide concessions or funds toward your closing costs, or to cover maybe repairs, existing repairs that they don't want to deal with prior to closing. So those are all things that can add to the assets or the cash or the money that you need in order to go through the mortgage process. That's it for this video. Don't forget to like or comment below if you have any questions. Subscribe and hit that notification button. Remember, whatever you put your energy and focus toward, you're bound to see progress.